So let's get back to some of the data from the top of the hour. A bigger than expected drop in U.S. existing home sales last month. They fell now more than 8% to an annual rate of 590,000. We haven't seen that rate since April 2020, and that was when the world was shut down. So with us now is John Fish, Suffolk Construction Chairman and CEO, plus he's chair of the Real Estate Roundtable. John, it's great to get your perspective. When you take a look at the housing market, we know the Fed wants it to cool. Are we looking at a cooling? Are we looking at a slowing? And what does more of a recessionary housing market look like?
So again, Alex, thank you very much for the opportunity to be with you this morning. And as we all know, real estate is extremely credit sensitive. And what happens is, because it runs on credit, high interest rates drive down sort of the ability to people want to invest in real estate. Couple the fact that we've got CPI now running at 9.1%, it's very, very challenging the industry as a whole. And when you mix that in with labor and material growing almost at 20% over the last year, it makes it very, very challenging. And our industry as a whole doesn't like lack of predictability. If it's not predictable, it creates problems overall because people really want to hold back on investing.
John, good to speak to you. You say it's sensitive to credit, and we can see that, and I know that's true. Is it less sensitive than it used to be? Have mortgages, in thinking about the transmission of monetary policy through the U.S. economy, have mortgages become longer duration? Is that a way that consumers are sheltering themselves from higher credit costs? Tell me about how that has developed in recent years.
Yeah, thank you. I think at the end of the day, what's happened is you see interest rates jumping almost 50% over the last 9 months or so in the industry. You've gone from 3% for a mortgage up to 6% right now. And with the Fed raising interest rates predictably 3/4 of a point tomorrow, all of a sudden you're going to see even further tightening overall. But I think at the end of the day, this is a short-term issue in our industry. I think people focus on what's going on today in the industry. But the bigger long-term issue for the home industry really is the massive structural problem that we have currently today. There is a fractured land use policy. Nobody wants building in their backyard. The federal government and the state government are not aligned, unfortunately. You've got a massive supply shortage right now in America. Over 7 million units are needed to be built. We're only producing 1.5 million to 2 million a year. And then also the major cost drivers right now. We've never seen costs explode the way they've exploded over the last 12 months.
Yeah, that's what I was going to say. Is we talk a lot about the demand and mortgage rates, but the construction material, steel, copper, timber, concrete, glass, tiles, I mean, you name it. And I mean, I'm wondering if the return that you look for when you buy property and then construct a house, how has that return profile changed as construction costs have risen so much and look much stickier than maybe we thought?
It's challenging because the more interest rates rise, obviously the compression of fees are created in the industry as a whole, and the more risks that's introduced. And at the end of the day, what you're going to see as a result of all these activities going forward is people are going to slow down. The Fed, by tightening monetary policy, is going to restrict the level of interest in what people want to do in the real estate industry as a whole. But I would also say this is a short-term challenge we're dealing with. And I think at the end of the day, real estate is a phenomenal asset to be involved with because year over year, decade over decade, it is one of the most valuable assets that an individual could invest in.
The challenges you see in the labor market, John, in the United States and in the construction industry specifically, are they short-term in nature? Do you expect those to endure?
It's interesting. There's fewer people in the labor market, in the construction industry, in the real estate side of things. I do think that is going to be a short-term problem, or issue, I should say. The reason being is right now our industry, for the first time, is introducing and allocating a lot of capital towards innovation. And we're currently using data for the first time, I would say, in the last, I don't know how many years. And I liken it really to Billy Ball in baseball. Nobody ever thought of using data in baseball back until the 1980s. All of a sudden, people now in the construction industry, in the real estate industry, are using data at a phenomenal pace. What's happening, people are realizing if you don't measure it, you cannot manage it. And I do think over the next 3 to 5 years, the increase in productivity, because of the fact that we're managing productivity, on an on-time basis, is going to drastically improve our ability to increase throughput.
That was a great analogy, John, on the baseball and the data. I'm also wondering if the way that we build stuff is also going to change. Like, am I going to go to the small-time construction place, or is it more like going to a place that has modular buildings where it's like, here's the 4 things I can choose from, and then they build it there, and then they kind of plop it down on your property. And if that kind of helps the supply profile going forward.
Let me try to briefly explain what I think is where the industry is going right now. Right now, things becoming digital in our industry on a global basis. And once you create digital drawings, and then you can use those drawings to incorporate artificial intelligence and machine learning, so those drawings become smart. All of a sudden, you will be able to access labor and materials around the world that can manufacture and currently come to the job site and install much more cost effectively. So we're a firm believer on a going forward basis that innovation in technology is going to drive down cost, increase productivity, and be able to address the shortage of housing in the long term. But again, I would emphasize what we really need right now in Washington is smart land use policy to allow us to incorporate things like transit-oriented developments, okay? Density. This issue of NIMBYism is really had a substantial impact on the overall real estate industry. So I'm bullish about the future at the end of the day, and I'm bullish about our industry leading the way with innovation in technology to drive down costs.
Dealing with NIMBYism and trying to change planning regulations is something that the UK has been wrestling with for a long time, John. But in your backyard then, smart land use policy, what's the one thing that needs to change to get there?
I think overall, I think a mindset. I think at the end of the day, what we really need to understand, the federal government and the state government have to be much more aligned with policy in order to drive incentive to create workforce affordable housing. If we don't have that alignment between the federal and state governments, I don't think we'll ever be able to overcome this particular obstacle. I am bullish because of the demand right now for housing that we will see a solution in the near future, only because it's a supply and demand issue at the end of the day.